The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk about taxes. And I have to tell you, it was like really a photo finish this year. There were just tons of people that came in at the end. I think that, I don't know what the reason was, whether it was the weather or whatever, but we're just thankful that it's over. We thank you for all the wonderful people that use our service and for the people that listen to us here on Saturdays on Ask the Tax Lady. And I have in studio Tiffany Fabian and Christopher Fabian. Hey, guys.
Hey there, Esther. How are you doing?
Esther.
Yeah, it's so funny. There were so many people that would sit in front of me and they're like, okay, so there's a lot of tax changes that we're about to do right now. And I'm like, no, that's for next year when you sit here. So a lot of people were confused by that, but yes.
Yeah, so that's what we're going to do this summer. We're going to get summer. We're all looking forward to summer. The seasonal affective disorder. I mean, last week I was, it's sad. I was just so sad because every time it snowed, I just couldn't get over it. So we are certainly looking forward to spring.
Yeah. Well, it's so funny. I went to the store today to buy Windex and a broom and a dustpan because I needed another one. And the lady said, oh, my God, it's 50 degrees here. And she goes, you can't believe how many people are buying cleaning supplies today. Yep. She goes, tons of people.
Well, we had a wonderful year. Any highlights of the year that you want to share with everybody before we're going to talk about, by the way, all right, so now we're like 4 months in to 2018. We're going to keep you abreast of what really happened coming down the pike now so that you can maximize your tax savings and understand what's happening in the tax laws in 2018 going forward. While even though it's imperfect because they're still kind of rewriting the law. But anything you guys want to share about things that went
I
on
would
last
just
year?
say one of my highlights is, like a single mom who has custodial coverage of her daughter, and she's a custodial parent, I should say more eloquently. And she was, every other year, she has to give the child to the father, and she was doing single, and she could have done head of household and EIC. She was missing for those years that she had to relinquish to the dad. And so just amending her return and getting her thousands of dollars would just be my highlight, because when you're doing somebody's tax return, you have an opportunity to review their last few years, and it just seems to be natural. And so I just love helping people.
Well, it's interesting. I had that same thing happen multiple times this year. People that had done their own return, it must be the software doesn't ask the question properly, but the law says that if you have a child that lives in your home, even though they're being claimed by the other parent because you gave them the right using the 8332 to claim the child, you still get to be head of the household and they still qualify for earned income credit. And I can't tell you how many returns I amended for that same thing. So if you have a child that lives in your home, even though you let the other parent claim them and you're single, that child qualifies you for doing the earned income credit and head of the household.
Yep.
Right?
Yep. And then another rewarding thing is I can't tell you how many times people will refer people to me because I do a good job and I know tax law, and that keeps you going because Lord knows when you're working those long hours, things like that help to keep your momentum.
That's the whole perk of the job is to really, you're helping people.
Yeah.
That's the whole thing. I said to somebody, I think 3 times yesterday. I talked to different people. And, because they were kind of saying what a great business we had. And we said, well, I said, really, the money isn't what we strive after. What we strive after is to make sure that we serve the customer. And so it seems like if you just serve the customer, you have enough money to pay your bills and pay your staff. And so that's the great thing. right? Well, why don't we go to Celeste, who's been waiting on line one. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. And Celeste, how can we help you, ma'am?
Hi, yes. Before my dad used to do my taxes, and he passed away in 2014, I went to a lady that a friend gave me, and she did my taxes for 3 years, and then she retired. So this year I came up to Lewiston to EG Tax, Dave Mickey, wonderful guy, and he did my taxes. Now, when my father did my taxes, he did it with his friend who was an IRS agent, so they went and did the best they could for me, and I used to get like a $4,000 return. Mm-hmm. When I went to this lady, my return got cut in half to $2,000. I thought, okay, my son got older, he's not in, and stuff. So then when I went to Dave, I got $4,000 again.
Yay.
Is your son in college?
I'm wondering if I can amend the other three.
You can, but let me ask you a couple questions, Celeste. Is your son in college now by any chance?
No, he is not in college. He's 21. That's why he had to take him off. We had to go back and find. He had to do it again, Dave.
So to be fair to the lady, taxes are very complicated. So there could have been a situation in the past where something happened. But I will tell you, if your son's not in college, is he still living home?
Yes, he still lives at home with me.
But he doesn't make any income?
No, he does.
But to answer your question, you can amend if there was anything wrong, 15 and 16. So to answer that question, yes, you can amend if there is anything wrong.
Right. And so that's what I'd suggest you do. Just give us a jingle Monday at 632-7886. And what we'll do is we'll have you send over those other returns and we'll review them for you and have Dave take a look at them too, okay?
Okay.
Good point.
Thanks,
good question.
Thank you.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We have a text.
Yeah.
What does the text say?
It says, hello, Esther. My husband received today a check from New York State. What is, it says on the check, income tax special refund account? Christopher?
I was trying to look that one up because I saw that come in. And there's really nothing out there.
Was he due a refund from New York State?
It could be many different things. It could be he got part of his refund. It could be that part of his refund was seized to pay a debt. The best thing is to, I hate to keep, like what Esther just said, to call us on Monday next week. But so we could, and bring it in and we could take a look, call New York State if we have to.
Or even
but if
from
she
your
got...
home.
If they got the full refund, I wouldn't be too worried about it.
Yeah, or even from your home, call me at the office, and I can do a conference call with you, so we could call New York State.
But the bottom line is, with New York State especially, they short refunds, they limit refunds, they hold up refunds, they ask for letters to prove withholding. They use all kinds of little tricks to hold up your money, and if that's the case, don't just sit there and let them do it. Give us a call. EG Tax will help you to stand against New York State because I hate to say it, but they do that a lot. Mm-hmm. And there are some of my clients, I had clients on the 18th who said that they still hadn't gotten their refund from last year because the state had been holding it up. And it was interesting. I'd written 2 letters that day for clients saying, gee, where's my 2017 refund? 16 refund, rather, that was due in 17. I had complied with all your questions. And so, especially with New York State, if that wasn't the refund you were expecting, give us a call. We're very happy to help you.
Yeah, and the office phone number is 632-7886, 632-7886.
Okay, so the focus of the show, and really for the focus of the summer, is we're going to get you so that you know the new tax law and how it affects you. There are going to be some winners. There are going to be some losers. There's some great things in the law. There are some things that are very not great at all. It's interesting. I was talking to a guy yesterday that works at one of the local banks, and he's an outside salesperson, and he says, I just can't believe I'm supposed to pay my own expenses because the company can't, there's no deduction anymore. So that's just one of the things. So those are one of the losers. So we're going to take a short break. We're going to be back on the other side with your calls, 8030930, 8030930, star 930 on your cell phone. I'm Esther Golias, Gullius, the tax lady. Taxes continue. We'll want to help you. Talk to you on the other side.
It's times like these you learn to live again. It's times like these.
Hey, I want to tell you, I'm learning to live again because when you work 7 in the morning till 10 o'clock at night,
No,
it's really unusual. I mean,
later.
you feel like freedom when you're out at 5 o'clock, right? I'm going to the movies tonight.
Wow.
I'm going to go see a movie show.
What?
I can't believe it. Anyway, it's great. We had a wonderful tax season. We thank you for all of you that used us, whether you called us, we were able to serve you, do your tax return. It's our 28th year of increase in number of returns that we've completed, and we just want to thank everybody. We have some callers, 8030930, 8030930, star 930 cell phone. We're going to go to Jim in Amherst. Hey, Jim, how can we help you, sir?
Hello, Esther.
Yeah.
You know that. You just said that, of course.
I know who this is. I know who this Jim is.
Just wondering about the changes since there's itemized deductions are not going to be allowed after this year.
Not true.
Well, that's not true, Jim. It's not like itemized deductions are not going to be allowed. The only category that's been eliminated is the miscellaneous itemized deductions subject to 2%. Medical is still deductible. Taxes are still deductible with a
Charity
maximum up to $10,000. Mortgage interest and home equity interest is still deductible on your primary home, and the home equity is limited to home improvements. Charity is still deductible. Casualty losses, if you have a federally declared disaster area, is still deductible, and gambling losses are still deductible. The only thing that's not deductible is the miscellaneous itemized deduction for the outside salesperson, brokerage fees, tax preparation, legal fees for the production of income, repayment of income after the first year. Those are things that are going to be not deductible. But the interesting thing is, what we've seen is over the tax season, what have we noticed, guys?
That there, as I peel back the layers of the onions, there's things that we thought were gone that really aren't gone.
They're adding them back in again. What we're going to talk about, though, Jim, is that the standard deduction, depending upon what your filing status is, makes it more difficult to get the benefit of itemizing that you would have gotten in the past, but it's still deductible.
And then I think it's interesting to see that the tax reform is just slated for 6 years, and you know, it could go away sooner, right?
Well, I mean, but again, they're enhancing. I think that a lot of people, from a lot of things I've read from a lot of the accountancy journals that I've been reading, is that they felt like they really too quickly decided on some of these things, and so they're adding things back in. Like this year, and during this tax season, the tuition and fees deduction was not supposed to be allowable. MIP was not supposed to be deductible, and neither was energy conservation. But in February, they made it retroactive. And then just 2 weeks ago, they said that home equity credit lines were not deductible, but then they said they were if you were using it for the upkeep and maintenance and improvement of your personal home. So it'll be interesting to see what they do throughout the year, and we're really waiting for the guidance from the Internal Revenue Service right now.
Yep. If things that you just heard that have changed, that are impacting you, we have different strategies we've come up with to help people to better their tax situation, like with the gentleman who has the employee business expenses. Maybe it's better to go back to work and ask for a reduced pay. Oh my God, a reduced pay, but then getting an expense check, a reimbursement check, which you won't pay tax on.
Right. So it was interesting. This person I was talking to yesterday, I said, so let's say you make $150,000 a year and $30,000 of it is for sales expenses. Well, now you can't deduct that, so you're going to be taxed on the whole $150,000 because the miscellaneous itemized deductions are not allowable. Well, I said, go back and ask for your salary to be cut back to $120,000, and then ask for dollar reimbursement on that other $30,000. Your package is still $150,000.
Yeah,
but all that's taxed is $120,000. So you save the FICA, the 7.65% on the $30,000. Your employer still gets to deduct it, right? and your salary package is still $150.
That's right. And then not to mention the other part of the equation is what is New York State going to do with all these itemized
Which
deductions
is true,
and taxes?
New York State doesn't know what to do right
Yep.
now.
But they got to figure it out.
Let's go back to the phones, and we have Jim again. Hey, Jim, how can we help you? I'm Esther Gilius.
Yes, hi. I was wondering, I have a situation where I have a relative who is elderly, and they want to divest themselves, and they want to give more than the standard amount for a gift, or like to help out a person that doesn't have as much, and they're younger.
So they want to give it to a non-charity.
On either side of the fence, how is that declared? On the one side that's receiving, it's a gift, but it's more than the amount.
Right. So, Chris, why don't you address the gift tax return?
Sure. The law is you can give up to $14,000 per person without doing a gift tax return per year. And everybody hears the word gift tax and they start freaking out. Mm-hmm. The gift tax return is just a paper return. There is no money owed. It's just saying Jim gave Sue money in the amount of $20,000, and then Jim gave Betty money or stock in the amount of $30,000. And all it is a bookkeeping form to show the government that you transferred assets that you had to somebody else, which then later, hopefully much later on, when you die, it takes right now it's $5 million exclusion going up to $10 million. It will bring that $10 million exclusion down any amount that you're over.
So $14,000.
Yep.
So the first party can do more than 14, like let's say up.
You can give, like Jim, you can give away $100 million right now if you wanted to. If you do, then you do a gift tax return because that would be over the maximum amount. That would affect the gift tax. But let's say that you give $500,000 away to a relative. Well, then you do a gift tax return for that, and it just adjusts the price exclusion.
We missed Jim? The last question.
Yeah.
Jim?
Yes, hello.
Yeah, what were you saying?
I was a little confused as to the giver has to do a gift tax return or the receiver?
The giver, and the recipient has to do nothing. They don't have to claim it as income. They do nothing. They can enjoy the money.
I see. So the giver wants to, let's say, buy an annuity for the receiver out of their generosity. They would just file a gift tax return that they gave so-and-so such amount of money.
Right. Now, here's the thing. If you're married, are you a married gentleman, Jim?
No.
Okay, but for those people listening, if you were an individual and your spouse was an individual, you could give 14. Their spouse could give 14. So you, in essence, give $28,000 to that person, and you don't have to file a gift tax return.
I see. But this individual is single, and the receiver is single, so they're just wealthier, and they would like to do this, in their lifetime,
right?
Rather than after death.
That's great. They can do it.
Okay. Thank you. You guys.
Well, thanks.
Great.
Thanks for calling.
Good question.
Right. Good question.
People are very confused with gifting all the time.
Yeah, because the recipient, it's not taxable to the recipient. It's non-deductible to the donor. So the person giving it doesn't get to deduct it. The person receiving it doesn't have to pay taxes on it. The only time that a gift is tax deductible is when you give it to a qualified not-for-profit charity that qualifies for tax deductibility, 501c3 charity. So aside from that, it's just non-taxable to the recipient, non-deductible to the donor, and if it's over $14,000, the donor has to do a gift tax return, which keeps track of the money given over the $14,000 in the donor's lifetime to adjust the unified exclusion upon their death. Right?
Yep.
Okay. I'm Esther Gilius, the tax lady with Tiffany Fabian and Christopher Fabian. We're from EG Tax, and we want to help you in whatever questions that you might want to throw our way. Maybe you're thinking about gifting a house. You're wondering about elder planning. All of those kind of things are absolutely on the table. But we do want to mention about how things are changing. The times are changing. and a lot of people have alluded that one of our other callers, Jim, who called, asked about itemizing. Now, the standard deduction is increasing. So if you're single, the standard deduction is now $12,000. If you're head of the household, it's $18,000. And if you're filing a joint return, it's $24,000. Okay, so that means that until your itemized deductions come to those plateaus, then it's not going to be in your benefit to itemize because you'd get more from what they just allow you. Now, to offset that, they took away your personal exemption. So if you had 4 kids, it would have been about a $14,000 deduction. That will be gone, but you'll get a higher standard deduction. So it's real important that you understand that you need to tax plan to get the best bang for
And
the
then,
buck.
Esther, why don't you explain the new family?
Well, I'm going to talk all about that, but we're getting close to the news, and I thought, rather
Save
than
it.
do that. But remember, the medical's still deductible. Taxes are still deductible up to $10,000, state, local income taxes. Mortgage interest is still deductible on your primary and secondary mortgage. If your secondary mortgage did home equity, charity is still deductible. Casualty losses on a federally declared disaster area are deductible, and gambling losses. So all of those things are still deductible, and how you put them into play are really important. Especially now, if you're a single taxpayer, your standard deduction is only $12,000. So it's, especially in New York State, if you own a home, that's not a high bar to meet.
Nope.
Do you guys agree with that?
I agree.
Yep.
Strongly.
Right. Anyway, so I'm Esther Gilius. We're going to take a short break for the news. We're going to be back with your calls. We're going to explain some of the changes. 8030930, 8030930, star 930 on your cell phone. See you on the other side. And tax season's over for tax year 2017. We do taxes every single day. You get letters, letters, we get letters. I mean, we will help you with your letters. Come on in. Even if we didn't do your return, we'll interface with the taxing agencies, explain, because they kind of write in hieroglyphics, and so it's important how you read those letters so you can understand what it is. Many times the letters are absolutely incorrect. They're just using the information that has been given to them, and they don't know that you sold stock and that had a loss, and once you react to it in language that they understand, it eliminates the balance due if you got a bill. If you're getting letters that say, we want to, from New York State, prove your deductions, will help you to fax over proof of the state withholding. If you don't do anything, they will not send you your money. So you have the ball is back in your court, and you have to address these things. So if you're somebody that procrastinates and you just don't want to do it, you are throwing away money.
Yep.
Right?
Yep. Don't do that, because the statute of limitations is 3 years, and so if you wait too long, then you're going to be out. And we'll help you.
It was interesting. I had a client that for 2 years in a row, the state of New York held up their refund, and they were just absolutely out of their mind. And I said, change your W-4 at work.
Yep.
And they said, well, what do you mean? And I said, instead of claiming single on your New York State withholding, claim 3.
Yeah,
so you don't get a refund.
It's so
Give
funny.
them
I
the
just
money. Let them wait for your money.
Yep, I just said that to a client the other day. She has had her identity stolen twice now, and so her refund from the IRS is held up again. And I said, please, for the love of God, change your withholdings. And she says, I've never been a really good saver, and it was my way of saving money. She said, you know what? Me and my significant other just thought of another way. I'm going to open up an account. He's going to save the money for me. I won't spend it, and say la vie. So.
Well, anyway, but changing your withholdings so that you get it up front, then it takes the ball out of their court and puts it in your court, and you get your money up front.
Yes.
Okay, let's talk about some of the things that are changing. 8030930, 8030930, star 930 cell phone. By the way, we got a super seminar coming up this fall that we're going to help people with. And if there's anything else that you think that you would like addressed, you can email us through our website at dgtax.com and tell us what you'd like. But right now, we're going to talk about all the tax law changes.
Yep.
And
What
that changes, almost seems to be every day. Hate to say that. But, we're going to, during the summers, we have our special guests on we bring them on to help you. And that gives you an hour. But we thought, why not bring everybody together in the fall this year, and we'll have someone talking about bankruptcy, estate planning, exchanges. We'll talk about
real estate, right?
With real estate, which those laws have changed too. We'll have an educational specialist, anybody that we feel that can help people do better for themselves. We're going to try to have open to the public. And it's just that's what we do here.
And medical insurance. And the other thing is, a lot of people think that under Trump, that the penalty for failure to have medical insurance is gone. That doesn't happen until 2019. So 2018 is what we're in. You need health insurance, or else you're going to be penalized. So if you need help with your health insurance, we have Tim and Karen on staff who will help you to get health insurance. So don't, when you listen to the headlines say, oh, they've eliminated the penalty, but it's in 2019, not 2018. So you're going to have a problem with this year. So you got to make sure that you get your health insurance for this year. Okay, so we talked about the increased standard deduction. We talked about that the itemized deductions are still there. So let me give you an example. Let's say you're a single person making $50,000 and you have medical bills that you paid out of pocket because you have high deductible medical of $4,000. So they're going to reduce that by 7.5% of your adjusted gross income. So you end up with a $250 deduction on medical. Your taxes are $6,000 from New York State withholding, and $3,500 property taxes of $6,000. New York State withholding of $3,500, so that's $9,500. So that's under the 10. That'll still be deductible. Mortgage interest of $5,000. Charity of $2,000. So in this single person's situation, they'd have itemized deductions of $16,750. That's going to be reduced by a $12,000 floor. Standard deduction.
That's right.
So this person gets an excess over standard deduction of $4,750. So yes, this person is going to itemize.
Right. Yep. So that's contrary to what Jim said earlier, and so you really want to pay attention to these things, you know.
So, and I'll give another example: married couple, married filing joint, $80,000 adjusted gross income, medical of $8,000 less their floor would give them an excess of $2,000 medical, property taxes of $6,000, New York State withholding of $5,000, which would be $11,000. So that's going to be capped at $10,000. Okay?
Mm-hmm.
Mortgage interest of $8,000, home equity credit line of $2,000, so that's $10,000. Plus charity of $4,000, so they have total itemized of $26,000, which is going to be reduced by $24,000. So they have an increase over the standard deduction of $2,000. So I just thought it was important for people to understand that itemized deductions are still in play, but you are going to lose some of the. It used to be the standard deduction was how much, you guys?
Standard
$12,000 married joint.
For married joint, about 12.3,
Right.
12.6.
So when they doubled it, it made it more difficult to itemize. But there are many people that can. The other thing is, if you have required minimum distribution, you can do a direct rollover from your IRA to a charity if you wanted to, and that fulfills the RMD. And it makes it not deductible at the same time. So that's still in the law. And so for those of you that are generous and like to give money to charity, that's a tool in your toolkit that'll help you to reduce your tax liability, right?
Right. And, people always say it's really hard for medical because it's 7.5%.
That's not very high.
But this year, the three big things that people don't realize, at least that I've seen, are dental implants that count. Cataract surgery, and hearing aids,
Medicare,
and your floor.
Yeah, I mean,
and your floor,
deductible.
Where you have to, your deductible, where you have to get up to a certain amount of money in order for you to have them pay for your medical bills. People forget about the floor.
Yeah, and if you're on
on
Obamacare through the exchange, the cost of the health insurance, they don't realize that cost goes on to it too.
That's exactly right.
And really, it used to be 10%, and for this year coming up for 2018, it's 7.5% again. So the point is, you should really keep a tally of your
That's
medical.
Right, keep track, right. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. All right, the other category that's gone, as we talked about, and this to me is the group of people that are going to hurt the most, and I don't even understand how they can say now. And people think, okay, so this is not deductible for employees, but if I have a business, is it not deductible? That's not true. If you have a business or rental property, these things are still deductible. If you're an employee, you're the only one that's getting shot in the foot, so to speak. So your mileage, that maybe you're an outside salesman, you can no longer take mileage. Office and home, gone. Again, if you're an employee. Meals and entertainment, even if you're self-employed, entertainment is no longer deductible at all.
Right. Yep.
Right, for no matter what your category is. But meals are deductible if you are providing meals to your employees, if you're doing team building, if your employee's out of town, that's still deductible at 50%. But entertainment is not deductible at all. Out-of-town travel would not be deductible anymore, again, if you're an employee. Parking and tolls, airfare, not deductible if you're an employee. So the way around it is what, like we talked to at the beginning of the show, is go to your employer and say, look, I spend $10,000 out of pocket on these things. Can you reimburse me $10,000? I'll take a pay cut for $10,000. Just make me whole. Then what happens is your W-2 is $10,000 less. You get a reimbursement, which is tax-free. You save income tax. You save FICA. The employer is still made whole, and it's a workaround. And by the way, we'll happily come out to your employer and do a seminar on this to make it clear, especially if you have a business where you have a lot of outside salespeople. We are very happy to come out. There's no charge. We just want to make sure that people get the deductibility of expenses that they're incurring.
Yeah, because we're almost to May, and so we're a good chunk of the way part through the year, and so you really got to pay attention to these changes, because before you'll know it, the year will be over, and then you're going to do your return, and you're going to be like, gulp, this is really tragic, So
right.
you want to pay attention.
Here's some of the wonderful things. If you are, one of the biggest tax tips I can give is to have children. If you have children under the age of 17, you get a $2,000 child tax credit with a refundable feature of $1,400 per child. So that means, like, let's say you have 3 kids under the age of 17, your credit's going to be $6,000, but maybe only $4,000 of it wipes out your tax liability, right? So that means that you have some hanging over. $1,400 per child. The $2,800 would be an additional refund, a lot like an earned income credit.
Right. That they're going to start, giving people a little bit more for refundable. But how many people weren't able to take advantage of the child tax credit because the income threshold was $110,000, and now for a married couple they're bringing it up to $400,000. All
right, now this is a tax planning tip for people getting a divorce. When the non-custodial parent, the person that the kids don't live with, says, well, I'm paying child support, I would like to claim the child, bear in mind, each one of those children cost you $2,000.
Yeah, good point. Very good point.
So this needs to be a strong negotiating standpoint, because the non-custodial parent is going to end up saving $2,000 per child under the age of 17.
Not to mention, going forward, if you're a brand new divorce, alimony is something that the recipient doesn't have to declare.
That's
and it's
starting in 19 again as well.
Yeah,
right?
That's right.
So I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on your cell phone. During the week, if you have questions, you can go to our website at egtax.com, ask the tax lady, enter in your tax question. We'll get back right away and give you a scoop of whatever your question is. The other thing I wanted to mention is don't forget, if you're a U.S. citizen, with income in a foreign country which exceeds $10,000 or more, you needed to do your FBAR.
Yep. And then that's right. And I don't know if Chris wants to talk about that, but I wanted to also talk about something else, Chris. Oh, I wanted to say, don't forget, we also have an offer and compromise Division 2
that's for sure.
of EG Tax. So if you're somebody who has, neglected to pay your liability and you have this big debt racking up and the interest they charge is not cheap, you hear those commercials, we're paying pennies on the dollar, and that's what it is. We have a division at EG Tax which will help you do an offer and compromise, and I don't know if you want to speak on it a little bit, Chris.
Well, right now, we're going to take a quick break. We're going to be back on the other side. I'm Esther Gillies, the tax lady, 8030930, star 930 on your cell phone. We'll see you on the other side. I'm Esther Golias, the tax lady from EG Tax. This is our first weekend on the other side of the 2017 tax year, and we're moving into 2018, and we want to make sure you know what's happening. And by the way, anytime you need our help, you can go to our website, you can give us a call. Our corporate office is open 9 to 5, Monday through Friday. We're closed on the weekend, but we want to help you. I wanted to talk, I was listening about Judy Jack Lewis, who was talking about selling your house. This, they say make hay while the sun is shining. For people that don't know it, and by the way, you're going to find that all the tax laws that used to be are still in effect, okay, except for the miscellaneous itemized deduction and the caps on taxes. But most everything else in the tax law hasn't changed. The personal exemption is gone, but everything else is still in the tax law, which means that if you lived in a personal home for 2 out of the last 5 years, the gain up to $500,000 is tax-free if you're filing a joint return, $250,000 if you're single. So this is a great time if you're somebody looking to maybe downsize, to call somebody like Judy Lewis and list your house and there is such a backlog of people looking to buy houses. Sometimes there's 14, 15, 20 offers with a bunch of money over asking. You can't believe it. So those of you that are saying, gee, should we sell our house? Make hay while the sun shines. This is a great time to sell, and it's tax-free for 99% of the time.
Mm-hmm.
That's right. That's right. Own the home for 2 out of the last 5 years, and your gain for married couples up to $500,000 is tax-free.
Okay, let's go back to the offer and compromise. So you're somebody that owes money. Maybe it's multiple years. You owed money, now you owed money again, and you don't know what to do. You can't pay the bill. That's where an offer and compromise comes in, where you basically present to the Internal Revenue Service your woes. I just don't have the money. Here's proof that I don't have the money. And you come up with a plan of what you are able to come up with. You borrowed money from mom and dad to come up with a lump sum of money, or you want to make a payment program. They can eliminate a lot, if not all or most of your debt from taxes. But again, they're not going to approach you and say, oh, hi, would you like to do an offer and compromise? You have to do it. So if you have any questions, if you know loved ones who are behind the 8 ball with their taxes, give EG Tax a call, because like Tiffany says, we have a division that'll help you with that.
Yep. I mean, it's a great way to get under. It's not a bankruptcy, but it gives you a fresh start with the IRS, and all you have to do is stay clean for 5 years.
And the state of New York has one as well. That's
right. They're a little bit tougher, but you still can do it. And, I've dealt with both agencies, and they understand people get in hard times, and, they'll take any money they can.
And the reason they would get you out of this, because there is a 5-year period where you have to be a good girl and good boy, or else they come after you and get you right back to where you were. So it gets you an opportunity to want to work, because many people don't want to work anymore because they owe the IRS money. Mm-hmm. And so they think, well, it's all going there. So, but this gives you an opportunity to want to get back into the capitalism stream so that you produce more money for the IRS. I know we got other calls coming in. 8030930, 8030930, star 930 on your cell phone. Wanted to talk to you about the new credit for families, family credit, which is a $500 credit. That's brand new, coming up this year. Then there's also going to be a new way to prove who a qualified individual is that qualifies you to be head of household and have dependents. So that's another change that's coming up. And the other thing is the pass-through credits. And pass-through is a 20% credit, a 20% deduction on businesses, rental properties, real estate investment trusts. That is a brand new way to compute your taxable income by reducing the money that you made for business by the 20%. Now, if you're a very wealthy person, you have some more things you have to jump through, but suffice it to say, that's pretty much how it works. So let's say you have a business where you have a net profit of $100,000. And that was your primary source of income, you would have a $20,000 pass-through deduction. Let's say you have rental property where it produces a $50,000 net profit. You would have a $10,000 pass-through deduction multiplied by your tax bracket. So many people say, well, I like to keep, I want to keep debt on my rental property because of the tax loss. Well, now if you don't have a tax loss, you're still going to get a deduction. So if you can do better paying off your mortgage and getting the deductibility of the pass-through, that's something you want to look at.
That's right. That's right. I mean, what a tax savings there is. You know, make sure you're up to date. And I know there's some payroll. You know, if you're in a business, you still have to pay yourself.
Right. And so if you're hokey-doking and you're saying, oh, great, this is great, I'm just not going to pay myself a salary, so I get a larger pass-through, that won't cut mustard. Right?
Right. The pass-through won't work. And if you don't pay yourself, part of it, too, is they're going to tax your net profit as self-employment. So then you have to pay self-employment tax on your net profit as well.
All right, let's go back to the phones. We're going to talk to Dave. Hey, Dave, how can we help you, sir?
Hi, Esther. How are you?
Good.
Okay. One question. The offer in compromise, let's say the difference is $30,000. Is that not considered as earned income in the following year?
No.
It's not?
Mm-mm.
No.
Really?
No, I mean, if you're behind the eight ball, it's you really need to do an offer in compromise.
Yeah, and now one thing I can tell you is if you do an offer in compromise and say you offer $500, you have to have that money and pay the money
over 5 months.
Over 5 months.
That I know.
But I mean, it's really a great way to get straight with the federal government.
Yeah, it's different. It's different, Dave, than calling your credit card and saying, "Hey, I'll give you $2,000 to get rid of my $6,000 credit card bill,"
Right.
because that $4,000 could be income. The IRS does not do that with their debt.
Yay!
Excuse me. I'm sorry. Let's say I owe $100,000, and the offer in compromise say we get them to bite on $40,000. The $60,000 is not considered as earned income.
No.
Following year, right?
Nope.
Oh,
Nope.
Okay. All right. Do you have the cell phone number of the realtor that you have in mind?
Oh, you mean Judy Jack Lewis?
Yes, ma'am.
I don't have it off the top. You guys, you want to Google it?
Yep. Yep.
What Chris will do is he'll give it to you off the air. Okay.
Thank you, ma'am.
All right. Thanks, Dave.
Right.
Let's. The offer and compromise is absolutely a great tool that you have in your toolbox. If you have outstanding debt from the IRS and you can't pay it, this is your way out. Let's go back to the phones, and we got Mary. Hey, Mary, how can we help you?
Hi, I was wondering, is there any tax implications that I should be aware of if I want to do the Airbnb out of my home that I live in and own?
Yeah, it's rental property. So what you're going to do, it's income, just like any way of making money would, unless it's specifically tax exempt, it's going to be income. So you're going to be able to reduce part of your property taxes, part of your insurance, part of your utilities for the Airbnb, the extra liability insurance you might get for having strangers in your home, mileage to go take care of. Yeah, cleaning supplies, cleaning lady, a percentage of to total. So, however, let's say that you have guests in for 60 days out of 365, that percentage would be, and let's say they occupy 20% of your house, you whittle that down to a percentage so that you can reduce the Airbnb income by all those expenses.
I was thinking Facebook might be a good way to get a hold of Judy Jack too. Yeah. It's so funny. I just did one of my clients in Florida. She did an Airbnb, and it worked out just like you said, Esther. We did a Schedule E for her item in Florida that she did as an Airbnb, and it worked out really well. Money in, money out.
Right, and so I will tell you, it's remarkable to see how much money people can make from Airbnb. I have several of my clients, $28,000, and I say, why do people want to go into your house rather than to a hotel? And they said that's what people like to do. Hey, by the way, Judy Jack's phone number is 832-4838, 832-4838. She's like the #1 seller for Hunt in this area. She is a remarkable woman. And again, make hay while the sun's shining. You don't know what the real estate conditions are going to be next year or the year after, but you know what they are now. And sometimes it's worth it to change what you were going to do to maximize what you can get right now. And that's the way I've always looked at everything is, if you know what you can do it now, because you don't know what you're going to do in the future, and that's what's so important. But again, until next week, I'm Esther Gulius. By the way, if you guys have any questions, letters from the IRS, need tax returns done, do we do them, Tiff?
Oh, yeah.
We do. And, and one of the letters going out from the IRS real fast is that we're holding up your refund. We're investigating your credits and your withholding. Just give us time. So now the IRS is now doing a stall tactic like New York State.
Right.
Give us a call.
Oh, by the way, I had somebody text me something. If I'm not making money from a startup business, do I have to file it in 2017? No, if it's not operating, you don't have to. There's nothing to report. So once it's in business, then all the expenses for startup will go into the basis of the business.
Yep.
Okay? Hey, until next week, I'm Esther Gulius with Tiffany Fabian, Christopher Fabian from EG Tax. We love you. Thank you for everything. God bless. Bye-bye.